Let's talk about risk and insurance. Risk is the chance of any type of injury, damage, or economic loss. Probability is the likelihood that some risk will actually occur, and loss refers to any physical injury, damage to property, or disappearance of assets. So, what types of risk are there? First is personal risk. Personal risk is the loss of something of personal value, not necessarily worth a lot of money, but something that's valuable to you. For example, if you break your leg and you miss an activity that you wanted to attend, that would be personal risk. Attending the activity might not have any dollar amount value to it, but because you want to be there, it's something of value to you. The next type of risk is liability risk, and that's when you do something that causes damage to others or the loss of others' property. In insurance, liability always means the other person. So whenever you see liability, it's always directed toward the other person, not yourself. So for example, if you own a home and you have a broken sidewalk and another person trips and gets injured, that's liability risk. It's something that you did or failed to do, fix your sidewalk, that caused somebody else to get injured. The third type of risk is property risk. That's the risk of damage to your property due to theft, wind, fire, flood, or some other hazard. For example, once again, you own your home, you park your car under a tree that's on your property, and a storm comes by, the branch falls off and falls on your car, damaging your car. You lose the use of your car while it's being repaired and the cost of the repairs themselves. So that's a property risk. By parking under that tree, you're risking losing your car and the money to repair your car. So how do we assess risk? Before we can see how much risk we have to know what a risk assessment is. A risk assessment just involves looking at all the risks in your life and deciding which one of them are more serious than others and prioritizing them into a list. Once you have your risk assessment and you know what risks you have, it's time to try to do something about it. We have different risk strategies we can use in order to help minimize the amount of risk that we have. The first risk strategy is reduce. To reduce your risk means that you change your actions, but you don't stop the activity. For example, driving. If we wanted to reduce our risk while driving, we could limit the amount of driving that we do, make sure we don't drive in high traffic areas, and use any type of safety equipment that comes with the vehicle. The next type of risk strategy is avoiding risk. That's where we stop the behavior altogether. So once again, in our example of driving, we just don't drive. We walk, take the bus, use some other form of transportation. The third type of risk strategy is transfer. When we transfer risk, we continue with the activity, but we pay somebody else to assume the financial risk. And that's what insurance is all about. We continue to drive, but we pay a company to pay for repairs if we happen to get into an accident. So in our example here for driving, we can purchase auto insurance, or if we don't have auto insurance and it's somebody else's fault in the accident, we can sue them in court in order for them to pay for the damage to our vehicle and maybe to the injuries that we sustained during the accident. The fourth risk strategy is assume. When you assume the risk, you are realizing that there is a risk to your activity, but you're not going to do anything else about it. If something does happen and a loss does occur, you're just going to pay for it out of your own pocket. If you don't do one of the other three risk strategies, by default, you are assuming or accepting that risk. Now, there can be combinations of risk strategies. For example, shared risk is part transfer and part assume. We transfer part of the risk to insurance, but we assume part of the risk by having a deductible on our insurance. So we have to pay part and the insurance company pays part. And since we're paying part, then our insurance premiums are going to be lower. So we can have combinations of those four types of risk strategies. So our example of assuming risk, that's called self-insuring. You set money aside for yourself in case you have an accident. And when you do have an accident and have damages, you fix it yourself, you pay for the repair yourself, and everything is out of your own savings. So what's insurance? Insurance is simply a contract. It's an arrangement between an individual, the consumer, it's also called the policy holder, and the insurance company, who is the insurer. And the contents of the contract spells out what the insurance company is going to do to protect you against risk, what they'll pay for, what they won't pay for, and all the rest of the terms of the policy. So when we talk about insurance, there's lots of different types of insurance, but we're going to concentrate on 6 major types of insurance. The main 6 types of insurance are auto insurance, home insurance, health insurance, life insurance, disability insurance, and renter's insurance. And we'll have activities that cover each of these 6 main types of insurance later on.